In the year 2019, a market you've never heard of broke and your money felt the shock. Overnight repo rates surged, with some trades reported near 10% within hours. The New York Fed ran emergency repo operations, offering up to $75 billion that day. It wasn't a war or scandal. It was plumbing cash suddenly couldn't flow cleanly. And when cash can't flow, mortgage rates and credit costs don't stay separate. This video answers one question: no tips, no picks, no recommendations at all. How can bonds called risk-free still sit inside a system that can freeze fast? Repo is cash for collateral, like a secured loan backed by high-grade securities. One side needs cash now. The other wants safe collateral while earning a small rate. They swap cash for bonds today, then reverse the swap tomorrow or in a few days. That sounds boring until you see what repo turns bonds into. An emergency cash key. In repo, a bond isn't only an investment. It's a tool that unlocks funding on time. And when that tool stops working, markets don't debate value, they meet deadlines. Because the deadline is real, and it's measured in hours, not opinions or tweets. So repo is a hidden pipe under markets that looks harmless until the pressure spikes. One reason spikes feel sudden is information gaps. Repo prices aren't fully visible. OFR research notes limited price transparency can amplify imbalances and rate jumps. Dealers can't always see the whole market, so liquidity can vanish without a signal. That's why the first clue is often a rate print too late for a calm adjustment. The Fed's repo ops accept Treasuries and agency securities as eligible collateral. In 2019, the New York Fed offered up to $75 billion overnight, then repeated operations. Those actions weren't about saving trades. They were about restoring basic funding flow. Think of repo as the cash elevator in a high-rise. Jam it, and every floor feels it. So the question isn't, who's greedy? It's, what rules force action by tomorrow? Here's the common belief. It's collateralized, so this market can't be dangerous. That belief is reasonable, but it quietly mixes up two risks that behave differently. Collateral mainly reduces credit risk, but it cannot erase funding risk in a crunch. Funding risk means you can't get cash exactly when you must pay, even overnight. And in finance, must pay can arrive before the next headline even loads on screen. So the first danger isn't default. It's a sudden cash squeeze that forces behavior. In mid-September 2019, overnight money market rates spiked and turned volatile. Fed researchers linked it to big cash drains like tax payments and Treasury settling. The lesson is simple. Even overnight funding can become scarce, fast, and ugly. So don't ask only, is the collateral good? Ask, can it fund on schedule? That's liquidity, turning assets into cash quickly without a huge price penalty. Safety and liquidity overlap, but they are not the same thing when stress hits. Now watch the incentives that make repo feel less like finance and more like triage. Lenders protect cash and balance sheet capacity because those are scarce resources. Borrowers protect access because tomorrow's funding must arrive tomorrow morning. When stress rises, repo rates can jump and haircuts can widen at the same time. A haircut means you must post more collateral for the same amount of borrowed cash. It's like a $100 loan, but the bank suddenly demands your $200 watch as security. You're still safe, but you're now collateral poor, and the clock keeps counting. So you scramble for extra cash or extra collateral, often by the end of the day. How do you raise cash fast when the deadline is hours, not months or quarters? You sell what you can sell fast, not what you love, and not what looks cheap. And the easiest thing to sell is often the most liquid, most trusted asset. So, safe bonds can become the first domino, not the last, in a funding scramble. That's the twist. Safety can make an asset the system's emergency ATM in stress. Now add the accelerant that turns stress into speed. Margin calls and variation. A margin call is a demand for extra cash or collateral when prices move against you. If volatility jumps, margin demands can jump too, because risk models react quickly. So volatility creates cash needs, and cash needs create selling, almost instantly. And selling creates more volatility, which raises margin again, tightening the loop. This loop isn't a plot. It's incentives colliding with constraints, mechanically. Another constraint matters. Dealer balance sheets are not infinite or cost-free. When dealers hit limits, they intermediate less, and bid-ask spreads can widen fast. Wider spreads are the market saying, liquidity is expensive right now, pay up. Now you can see why good assets crash can be a plumbing story, not a taste story. Not about optimism or fear alone, but about funding schedules that don't wait. In March 2020, the world saw a violent dash for cash across multiple markets. Global stability reports describe forced selling and severe strains in market liquidity. Even U.S. Treasuries showed impaired market functioning at points during that stress. That shocks people, because Treasuries are treated as top-tier collateral everywhere. But Repo doesn't care about prestige. It cares about immediate cash access on time. So, a Treasury sell-off can be a funding scramble in disguise, not a credit panic. Here's the second-order effect most headlines miss when they blame sentiment. When haircuts rise, collateral gets trapped, and leverage snaps tighter very quickly. That forces sales, which hits prices, which triggers more margin pressure elsewhere. So plumbing can amplify a small shock into a system-wide rush for cash and capacity. This is why you sometimes see the safest thing sold first when everyone needs cash. It's not because it became bad. It's because it became usable under pressure. Now bring it back to everyday life, without turning it into advice or prediction. Repo is part of the channel that transmits short-term rates through modern finance. When that channel strains, financing conditions can tighten across many markets fast. That can show up as higher borrowing costs and less willingness to lend or warehouse risk. You won't see Repo on your banking app, but you can feel ripples in real prices. Mortgages, car loans, business credit rates can respond to funding conditions. That's why central banks watch market functioning, not just headline rate targets. And it's why they sometimes add liquidity against collateral via repo operations. Those operations aim to keep settlement and payments moving, not to pick winners. So the story isn't bad people. It's timing, incentives, and hard constraints. Everyone protects their own cash first, because the penalty for missing is immediate. And when everyone does that together, the system can seize up together fast. Quick check. Did you assume government bond automatically means can't crash? If yes, comment what surprised you most about liquidity versus safety in this system. If any term felt unclear, ask below, and we'll answer questions in the comments. Now here's a concrete replay you can run in your head, step by step, with no jargon. A fund borrows overnight using Treasuries, planning to roll that funding day after day. Haircuts rise, so it must post extra collateral by day's end, or find cash instantly. If it can't, it sells Treasuries to raise cash immediately into a thinner market. Those sales push prices down, which can trigger margin calls elsewhere, spreading stress. So a safe asset becomes the transmission belt that carries stress outward, fast. This is plumbing. Invisible when it works, loud when it doesn't, and brutally quick. And it breaks fastest when the clock is shortest, overnight funding that must roll. Now the reframe that makes Repo click into place without turning it into a moral tale. Safety is about credit. Liquidity is about time, and time can vanish in a single day. Money isn't just value. It's access to cash when the deadline hits, under constraints. Repo is one of the deadlines, and it can force selling before humans can process. Next layer. Who gets emergency liquidity first, and what rules decide that access?